In payroll, we're mostly concerned with paying people the money they need to live on today. But what about helping them pay for tomorrow? Today, we're talking pensions on Behind the Button. Hello and welcome to Behind the Button, the podcast that really lifts the lid on what goes on behind the scenes in the world of pay. I'm Laura Murphy, the CIPP's content editor, and I'm here today to talk to somebody who knows automatic enrolment and pensions like the back of their hand. Welcome to the show, Andy Nicholls.
Oh, well, thank you. Thanks, Laura. Yeah.
Thank you.
Looking forward to see what happens.
So on Behind the Button, we ask our guests to leave a parting question for the next guest. And your one, I'm not going to lie, is quite tricky. So if you're not allowed to say AI as your answer, what do you think will be the biggest disruptor to the pay communities over the next 10 years?
For me, I remember my first ever job in payroll was in April 1983. Now, if anyone is aware of what happened then, it would be introduction of SSP. And that was it. And that was like, wow, that's a big change from NIB as it was to SSP, all put onto the employer. And I think legislation is what will drive change most. Throughout the whole of my payroll and pensions career, it's been legislative change that has made the most, I don't know if I say positive, but it's certainly the biggest impact on payroll is that. And being able to keep up to date with it. And maybe AI will help with that. But you as individuals have to keep up to speed with what's going on in the world of payroll.
So if you weren't working in the pensions field, what do you think you'd be doing, or what would you like to be doing?
Well, I do actually have another job.
Oh, okay.
I work as a chaplain in the prison service, an open prison. So that's quite complete contrast to payroll. So that's helping people get to the point of release and resettlement. But that was 2018 I started that. Otherwise, what would I do? I did train to be an accountant, started doing an accountant, but if I can be honest, it was really boring. So I stuck to payroll and kept doing payroll. Otherwise, I'm not sure what I would have done. You know?
I like that you touched upon there that you went to payroll because another career choice was boring.
Yeah. Because
a lot of people outside of the industry do look upon payroll as being boring, which we of course know it isn't, and there are lots of different strands to it. So I'm really glad that you swayed away from something else that you thought was boring and came to something more interesting.
Yeah.
So in your time in pensions, what has been the weirdest ever question that anyone's ever asked you?
You get quite a lot of technical questions. Sometimes you get people asking you for advice, but of course, individual advice is regulated by FCA and you can't give advice and give facts, but not advice. And so then they get a bit upset by the fact that you can't tell them what to do with their investment, their pension stuff. I do remember going to a meeting once with a large payroll provider, and I was explaining, for the first time, they were the first ones that I'd done re-enrolment with so they could build their system. And my boss came along and he questioned me all the time. He said, "You sure that's right, Andy? You sure that's right, Andy?" And I said, "Yes, it is, it is." And afterwards I spoke to him and said, "That wasn't very helpful." And he said, "Well, I hadn't looked it up myself, so I was just checking, you were informing me how it worked." I thought, oh, that's not the best way of doing it, but it's quite interesting.
Yeah.
But yes, so maybe that is the weirdest situation I've been in, when your boss is questioning your knowledge, but in a good way. Yeah.
So you touched upon a really important point there, and something I was actually going to come along to later, but let's address it now. So this thing about giving pensions advice, we know that in the payroll department people come with all sorts of different questions around more broader tax, financial well-being and pensions, and obviously there becomes a time where pay professionals can't answer pension questions because, as you say, they're not qualified, and you know, nobody wants to give pensions advice for then someone to make the wrong sort of decision for them. So what advice would you give to pay professionals who are in that situation where they can't sort of answer one of the questions that's being put to them?
Because it is regulated, the Financial Conduct Authority are responsible to oversee people who can give pensions advice. So you, as a payroll person, you just need to refer them to say, go and find an independent financial advisor and speak to them about it. Interesting enough, employer to employer isn't regulated. But from a payroll perspective, just give them the facts. So if they say anything, you can say, well, actually, this is our pension scheme. These are what the scheme rules are. These are the contribution rates. Speak to the pension provider if you want more information, because they may have links on how to give advice. They may have people that they employ who are regulated. And the same with automatic enrolment. You can give them advice that if you want to opt out, this is how you opt out. But you can't say you should opt out or anything like that. You just got to stay well away from that. So give the facts about the situation, but do not give advice.
That's really helpful. And I think, payroll does often walk that tightrope of we can maybe, like you say, give you the facts, but we can't then tell you sort of how to go about things.
Even if you know, don't give them.
Yeah.
Don't do it.
So I was going to talk to you today, Andy, about automatic enrolment, because that is one area of pensions that does definitely touch payroll, because we know that pensions is a whole other field in itself as well. So in your experience, what are the most common sort of mistakes you see around automatic enrolment?
Automatic enrolment actually, at one level, is straightforward. It's you assess people if they meet the criteria of age and earnings, you put them in a pension scheme, and that's it. But actually, there's a lot of legislation around it, which makes it really complex, because there's a lot of choice which employers need to go through and work through. And when you start looking at, I work for the Pensions Regulator, and my role was their payroll expert in effect, and I was part of the serious and complex cases team. And every single employer I went with my colleagues, the compliance enforcement team colleagues, there was always something wrong. So for me, it's a big area, and some of them are quite straightforward. So for me, it would be look at your definition of pensionable pay, what you've defined as qualifying earnings within the payroll system. So does your definition of pensionable pay equal the same as the pension schemes? So are the pension schemes rules reflected correctly in the payroll system? That's important, because if you get it wrong, if the qualifying earnings are wrong, you won't be enrolling people when they should be, or if pensionable pay is wrong, you'll be miscalculating the amount of contributions, be under, maybe even over paying contributions, E's and R's. So go and look at your payroll, your payments elements tables, and check to see you've got the ticks right. It's taxable deniable, is it pensionable, is it qualifying earningsable, and check it with your pension scheme. Then tax relief. Two types of tax relief: relief at source, net pay arrangement. I know you could have salary sacrifice coming out in a minute. The relief at source, if you get it wrong, you're either going to give them double tax relief, or you're going to end up underpaying contributions. So either way, if you get the tax relief wrong, something is wrong. You need to go and look at it. So some things are fairly straightforward. An insured scheme like group personal pension scheme, always relief at source. If it's a master trust like Nest, that's relief at source, because master trust pension schemes can determine what their scheme offers. So now, net pay arrangement. People's, though, for instance, default to relief at source, but you can choose as an employer net pay arrangement. So you need to check, particularly payroll bureaus. Your client may not understand it, but hopefully you do. So look at the scheme they've got. That will help you identify it. But you find out, ask the pension scheme, what type of tax relief is it? Because if you get it wrong, it's just a big mess to unpick. And you as an employer may end up footing the bill. So don't get it. Just check your records. Go back into your office and just check your payroll records for your tax relief method. Salary sacrifice, particularly with statutory payments, so maternity, statutory maternity pay, adoption pay, except parental pay, you've got to be so careful, because if you have a salary sacrifice scheme in place, then you as an employee have chosen to give up part of your pay in exchange for an additional employer contribution. And you probably already know, or hopefully you already know, and therefore it's all built into your payroll system, that if you go on maternity leave, for instance, during those 39 weeks of paid maternity leave, when you get an SMP, then salary sacrifice cannot be deducted from SMP payments. You have to pay SMP in full. So therefore, if there's no other additional payments being made from which the employer might be able to recover, subject to the contractual agreement for salary sacrifice they may have with the individual, if there's no additional payments, then there is no salary sacrifice amount to be deducted from the individual. Guess what? The employer is responsible for the full amount. So the employer has to pay their normal employer contributions and the salary sacrifice. And both of those will need to be paid based on the pay the person would have had they not been off on maternity leave, their full salary, for the whole of the period or SMP. And it can get even more complex while it's in my mind, because the scheme rules might require more. So what does this pension scheme rules, what does your contract of employment say about pension contributions during periods of leave, which could even be sick leave? So just make sure you know what it is. And if you've got a defined benefit scheme, remember that's slightly different, as in you still need to pay the full employer contributions, but you need to make sure that the scheme is recording the fact that this person is entitled to the whole of that time on maternity leave, the paid maternity leave particularly, as if they were still employed on full pay. So that the scheme records it and they're going to get pension based on that full level of service. I do know that on those inspections, some employers have had to go back when they've been inspected by a regulator and go back many years and recalculate all their SMP cases because they've got it wrong. And that can be a big bill, but very important for the individual for their future pension benefits. So they're probably the main ones. There's a lot of little things like communications are wrong, like the letter that you send out. You have to send a letter to someone, either said they've been postponed, enrolled, or they've got the right to opt in. And if you get those letters wrong, chances are, as a regulator, they would come in and say you need to change the wording. But possibly you've issued a postponement letter late. And if you've issued it late, got 6 weeks and 1 day from the point that postponement letter was due to be issued to get it out. And if you don't, then they're not postponed. So you might have postponed people, but in fact, the regulator could say, right, those 6 weeks plus, you need to treat them as if they were enrolled from day one. And all those contributions due. And just to think about it, if you do get it wrong, a regulator gets involved, the chances are the regulator will say you've got to pay the missing employee contributions as well, as an employer contribution. So, yeah, it can be quite a big impact, unfortunately. A lot of work for payroll, a lot of work.
I think a key point there is to check. So whatever you're doing in terms of the pension scheme, just go back and check. You need to check the pension scheme rules and things like that. You know, double check everything is sort of the message there. So in terms of automatic enrolment, Andy, do you think it's been a success or do you think there's still a way to go?
Yes, to both those really. It's been a great success because the whole point of the automatic enrolment was to get people saving for their retirement. And that's happened. I mean, millions of people have been enrolled for the first time, and those who were perhaps already in are now paying more into the scheme. So a real success, and hopefully people will have really good retirements. But this is the other more to be done because, as you probably already know, the legislation has been put in place, just hasn't been enacted yet, to make the point at which you can be automatically enrolled, the age level, go from 22 down to 18. And for those schemes that have got a low threshold, that lower threshold go down to 0. So we're just waiting on DWP and the government to decide when that will happen. They said mid-2020s, which is, guess what? It's now. But I'm sure I heard the government say that they weren't going to do it in this Parliament time, partly because you will be increasing employer contributions that will put extra pressure and stress on the employer, perhaps not right in this current economic climate. But it will happen at some point. And if you speak to the pension providers, they're saying people aren't saving enough. The minimum is, and if it is just a minimum scheme someone's in, then it's only 8% of qualifying earnings between a lower and upper earnings limit, equivalent near enough to national insurance at lower and upper limits. And that 8% probably isn't enough to have a really good retirement on. So the pension providers are saying you need to pay more. And other countries like Australia, they'd say 15% would be a good thing. And I think that's what the pension providers are saying, that sort of level. So I think the contributions will increase as well. So wait and see. But it's down to the government, really.
Yeah. There is sort of a lot of change going on in that space at the moment. And you mentioned, people not saving enough for their retirements at the moment. It's really difficult because I think people are in a situation where they need their money now.
Yeah.
So they aren't necessarily looking forward to the future. What advice would you give to somebody who is sort of in that position around saving for their retirement?
Well, the facts are the more you pay in, hopefully the more you have as a pot of money. There's different types of pension schemes. So defined contribution scheme is where what you put in, what your employer puts in, builds into a pot. And then when you come to retire or you get to normal retirement age, see what the scheme says, but also you get to 55, 57 from April 28 is when you can first start to access those contributions without tax penalties. But you've got to think to yourself, how much, for me, looking at this personally, how much, what sort of lifestyle do I want when I retire? And then when you think, well, how much would that be a year? Is that 20k a year? 30k a year? Well, okay, and I'm going to live, who knows, 20 years, 30 years? Oh, 20 times 30 is 600,000. Wow, what have I got in my pot now? Oh, and the nice thing is that the dashboard is coming up, and the pensions dashboard, when it goes live sometime towards the end of 2026, 2027, I hope, will mean that you can log in to your dashboard and you can look at all the schemes that you've belonged to. And you can think, I've got that much money in that pot, and I've got this much state pension, I've got that money here, and I've got this is my current employment. Oh, is that anywhere near the 600,000 pot? Do I need to pay more? Can I afford to pay more? At least you get tax relief, which is nice. And it's that personal decision, isn't it, really? But I get it. If you haven't got the money to spend, you can't. But maybe your employer, and sometimes employers do matching schemes. What you pay in, the employer will match. So if you pay 5%, the employer pay 5%. If you pay 6%, the employer pays 6%. So that's really good because that's money the employer's paying, which is going to go in your pot, and it hasn't cost you anything, and it's just great. It's like free money. So that's something to look into, But these are the facts, remember?
Yeah. So you mentioned their pensions dashboards, and I mean, that is huge. It's been a long time coming, but as you say, we'll hopefully see more movement in that space soon. Yeah. Pay professionals that are watching today might think, how is the pensions dashboard going to impact me? But I think, there are ways that pay professionals are going to be impacted. I think they'll see more questions around, someone who's checked their dashboard and they've thought, that's not enough for me to retire on. They then might go and ask questions about increasing their contributions, for example. So can you think of any other questions that the dashboards might bring for pay professionals, and some advice around how they go about answering those questions, please?
So first of all, the dashboard, all the pension schemes, with I think it's 100 members or not above, need to have connected to the dashboard by the 31st of October 2026. The government will decide, the minister will decide when it will go live. So between now and October 26, pension schemes are connecting. So if your pension scheme hasn't connected yet, you may find you start getting questions saying, we've got a bit of missing data. We don't have the right, what is the address for this person? Because it's blank, or maybe national insurance number, date of birth, all the sort of standard identifying type information that an employee has. They may be asking you to fill their blanks or make sure it's correct, that it is in sync. But you're probably passing that data over on a regular basis anyway, certainly for new starters. So you may get questions, payroll may get those questions, maybe go to HR. So there's that information in the middle. But for me, as a payroll department, I would make contact with the pension provider. You may already have a contact in the pension provider, but if not, find out who it is and say, what are your plans? Who is looking after the dashboard? When have you connected yet? When are you going to connect? Because they've been given a date by which they should connect. So when is that date? Find it out and find out what their plans are. So what what sort of communication are they going to do to their members, your employees, when they're going to send those out? Because if they send out a note saying dashboard is about to go live for you, then you're going to get questions coming into payroll. So you can expect a little influx of at least some, most likely, coming into you to the payroll help desk. So find out what the pension scheme's plan is so that you can align your plan with that. But yeah, you could end up with asking, can I increase my contributions? How do I go about doing that? Well, is that an online process? Do they go to the pension provider and the pension provider tells you, or do they just send you an email? Are you a small, large employer? That will have a bearing. Are you a payroll bureau? Are you going to have a load of clients all coming to you asking lots of questions? So yes, it will have an impact. And align your processes with your pension provider. And of course, if you are a payroll bureau, you have lots of pension providers, won't you? But you can also find out from your clients what their plans are in terms of the dashboard. And hopefully it will be quite minimal because you've done that prep in advance. But it will have an impact. It definitely has an impact.
Yeah, and I like that you touched upon bureaus there, because obviously they have multiple clients, which then leads to multiple pension providers. And we did see sort of a notion of pot follows person.
Yeah.
So where that was going to potentially bring lots of admin burden in for pay professionals. Do we know where we are on that front at the moment? Have they moved away from that idea?
I hope so. Personal. I think I can see the value in it from an individual that, you start work and you join a pension scheme, and that pension scheme is a pension scheme that you're in for the whole of your working life. And as you go from one employer to the next, it's that pension scheme that your new employer pays into. But of course, the worst case scenario would be you've got like 100 employees, and each of those employees got their own pension schemes. You've got 100 pension schemes, 100 data files to send, 100 contribution payments to make every month. A lot of headache. I can see the value. It's all gone quiet. I think there's a lot of feedback when it was announced a year or two back. And I don't know. I'm not even sure the pension providers are probably that happy. I think maybe because when you look at it in more detail, you realise that the government are saying, and the regulator, therefore the pension regulator is looking into it, pension schemes need to offer value for money. So that when you pay your contributions in, you're going to get the best end result, the best retirement, because they're offering value for money, so your contribution values can grow because they're well invested, etc. And if the regulator said, if your pension scheme does not offer value for money, it will be closed. So I think it's leading to consolidation in the pension market. So the number of pension schemes over the course of time will become less and less. So maybe if that was really condensed, then that might work. Pot one, the person has that pension scheme to start with and it follows them throughout their life. If there's only like 20 pension schemes in the whole of the UK, then maybe that's not too bad. Who knows really what that consolidation will look like? I don't know. Yeah.
So, Andy, when you're talking, I can tell you're just completely passionate about pensions. So can you tell me where that passion comes from?
Oh, well, obviously, personal investment. It's good to have a pension scheme. I started work in local government, Milton Keynes Borough Council. I then left the local pension scheme. I then worked for Mercer, which is employee benefits consultancy, specialising in pensions. Although I was their payroll manager, which went from when I started 400 employees and I was a payroll assistant to 10,000 employees by the end in 20 years. But because it was a pension, mainly focused on pensions, but reward strategy and everything else, everything that happened on the world of pensions legislation drove business. And so when smart pensions, salary sacrifice pensions came in, guess what? Payroll had to do it because the consultants were saying to clients, you should do this. And then the client would quite rightly say, well, what are you doing? And we'd say, yeah, we're doing it as well. So it was that, I think that little bit of starting point whereby we were doing more and more pensions. We even wrote our own pensions interface to pass the data over to the pension scheme because it's an internally administered scheme. We even ran the pension and payroll for Mercer's because it was keeping it for not until it was given over to the main pension payroll thing. So it was like I was immersed in this payroll pensions world. And then next thing, I ended up working for a software company, payroll software company, as their support manager. And that you end up with questions on pensions. How does it operate? How can we get the data files out? And then a job came at Pensions Regulator, and I thought, I'm going to go for that. And that was really fascinating because it's like, wow, I didn't realise how big pensions was. I thought I knew pensions, but now I know even more. And And although working for a government organisation is quite interesting as well, because you then realise why it can sometimes take a bit of time for legislation to go through, because an Act of Parliament can take years to get processed. Meanwhile, regulations can be implemented on a fairly regular basis. But you could see what the aim of the government was, to try and get people saving for a good future. So the whole of my career seems to have been payroll, but pensions, and then it ended up being pensions. So I'm really pleased, actually. It's good, exciting, and eye-opening, really. Yeah, never boring.
Yeah. So that's sort of a common theme we see in the pay industries. There is so much more when you peel back the curtain. There are so many different areas you can get involved in. It is quite complex, so there's lots of changes to keep your eye on. So for anyone that's listening or watching today, Andy, who's thinking, I want to get into pensions, what is the best piece of advice that you could give them?
There's two types of pensions, isn't there? Is it pensions in payroll? And just work in payroll, you're going to do pensions. It's like, since automatic enrolment, payroll has become the key thing that makes pensions work. But on the other hand, you can work for a pensions company, and then you can see how pension schemes are administered, how the money is invested, and lots more. So which area do you want? Because for me, I'm very much pensions in payroll, but I've also had this world of pensions opened up to me, especially working with colleagues who would go and speak to pension providers. I'd go along, speak to Nest peoples and so on, and you'd see, this is actually similar and yet different to payroll. Where do you want to go? CIPP is a logical thing because it's got both pensions and payroll, but there's PSLA and various other things, qualifications in pensions. I think probably over the past, 2012, automatic enrolment came in. A lot of people went on a load of training courses, and I can see now, just from talking to people, doing the inspections, that people don't know automatic enrolment rules. They don't know the pension scheme rules. I remember asking one payroll manager in an inspection, large company, they had pension specialists, payroll, etc. I said, so what are your postponement rules for automatic enrolment? And they didn't know. And just as a top tip here, if you don't know, the regulator is going to think, what else then? Because the system did it. The system rules were set up at the beginning, and that's what it did. It just applied postponement based on the rules set up then. But you should know. And I think the lack of knowledge has come out for me when I speak to people. I think, I know you don't know. And I really would love people to refresh their payroll knowledge on pensions, because you'll get caught out.
You were talking there about people not sort of understanding some of the rules, and I know at the CIPP we get a lot of questions around re-enrolment. So can you give people any tips around that as well? Because I know that's an area where there is a bit of a gap in knowledge.
There's actually two types of re-enrolment. There's immediate re-enrolment. So if the pension scheme you've got no longer is qualifying, maybe because contributions rate aren't enough, or it could just be simply that you're changing pension schemes, going from scheme A to a completely different scheme, say scheme B, then immediate re-enrolment basically means that on day one, or yesterday the scheme closed, today a new scheme has to be in place and people have to be automatically enrolled into that new scheme. So that's immediate re-enrolment. There's more to it than that. Re-enrolment in a normal sense is every 3 years. So you have a staging date if you were one of the early employers, or you got a duty start date now, and 3 years from that duty start date, staging date, give or take 3 months either side of that third anniversary, you pick a re-enrolment date. And on that day, you have to assess anyone who was previously in the scheme has come out, and if they trigger, you got to put them back in. And then that whatever date you've picked, 3 years from there, plus or minus 3 months, is your next re-enrolment date. And you just need to keep putting back people in who've come out on the basis that after 3 years they may have changed their mind and do want to be in the pension scheme, but they haven't thought about opting in. They've just, so that re-enrolment we'll put them back in. And if they don't want to be in, they can opt out. So it's okay in that respect, you know. So things like if you've got a weekly and monthly payroll, you only have one date.
Mm-hmm.
And if you're trying to align it to the start of a pay period, so first day of the month may be midway through a week, well, guess what? You've got to decide, do you want to start the week or start in the beginning of the month, if you want to do it like that. And whichever one it doesn't work for, they're going to be automatically enrolled, anyone that came out partway through a period. So you need to know what the scheme rules are. So does the scheme require so they get enrolled on a Wednesday, it's Monday to Sunday, is your pay reference period, get enrolled on Wednesday. Do they have a part week contribution? Does it have a whole contribution for the whole of their pensionable pay in that period, or no contribution? Of course, the legislation allows all of them. So what does your scheme expect? And guess what? Some schemes don't tell you. So you just need to have that conversation with the scheme to say the scheme rules are silent. So what will you do as an employer? What does the payroll system do? Because if it doesn't prorate and the employer and the pension scheme requires it, how are you going to overcome that? Because there's a lot of manual calculations. But as you say, prorated contributions can be nil. The scheme can allow nil. So you could just say, you've been enrolled on this Wednesday, but contributions start from the following Monday. And so you just start taking nothing in that particular week, and the following week you take a full contribution.
Mm-hmm.
You know. So look into it, and the regulator gives advice, and there's stuff on the regulator's website, so have a look at re-enrolment. But yeah.
Yeah, I think a lot of this as well, and the success of it relies on liaising effectively with your pension provider.
Mm-hmm.
So what tips can you give people on keeping that relationship healthy between the employer and the pension provider?
Pension providers, I guess it depends how big you are as to whether or not you'll have a dedicated resource. Otherwise, it's help desk. And I think the minute you think something's wrong, or if you've got something unusual going on, so you may have a bonus scheme and the individual wants to salary sacrifice their bonus, for instance, then where do you put that on the employer contribution? Is there a separate column on the output file for one-off employer contributions? So then you do need to liaise. So that might just be the help desk that you're ringing there. But if you can get a named individual, that is brilliant. Or a dedicated emails, at least you've got email stuff. But there are things, particularly when things go wrong, that you really then just want to ring them up and say, can you help me? We got the wrong tax relief, or we've been under deducting contributions, and how do we fix it? You know, that sort of thing. Yeah.
So as we move forward, Andy, what would you really like to see next for pensions?
Well, it's all happening, isn't it? The dashboard, I think, is brilliant, because then we're going to know as individuals whether or not we're going to have a nice retirement, or at least what we can do about it if we got the funds to do that. It'd be nice if they get automatic enrolment resolved in terms of when it's going to actually happen, because then we can all schedule it in our diaries, which presumably is obviously going to be a few years hence. Obviously, every budget, every Pensions Act can bring changes. You've got new pension schemes coming out, collective defined contribution schemes, which will allow multiple employers to come in, which is a bit of a mix between DC, DB. So watch out for that in case your scheme closes because it's going to go into a CDC. Or maybe a pension super fund will take over. Your DB scheme can be quite expensive for employers. The key is keep an eye out for legislation. Go to the ACE. Listen to people giving updates on pensions and things like that. Just follow it as best you can. And hopefully, if you've got that contact with a pension provider, then they'll be able to keep you up to date. And even if it's just sign up for things like get yourself registered on the dashboard, pension dashboard program, so you get updates on the pension dashboard. Sign up for your pension provider, so they give you updates. Sign up for you probably already signed up for HMRC, but HMRC has a link to pensions as well. So yeah, just try and keep up to date. But probably most importantly, CIPB will be able to in the weekly newsletter and everything, you get and so on. Just and don't just think, oh yeah, that's changing. Think, but what's the impact? That's vital, because otherwise he's going to creep up on you and then bite you in the bottom. Not good.
So you threw out a couple of acronyms there, Andy, which we do all the time. But I am going to ask you to expand on them if that's okay. So I think you touched upon defined contribution earlier, but you mentioned DB then as well, and CDC.
So DV is defined benefit, final salary, career average. Public sector pension schemes are all DB. And I want you to look them up. Look up what they mean. Because although, so if you're NHS, local government, teachers, civil service, they're and military even, they're all central or local government schemes, all defined benefit. What you're saying is there is actually what you pay in as an individual and what the employer pays in doesn't actually matter. That's not going to impact what you get as a pension. What you get as a pension is based on how much your pay is and how many years you've been in the pension scheme. So, and there's a factor, like could be 1/60th. So let's have a very simple example. So your salary is 60,000, because it's easy to do the calculations, and you've been in the pension scheme 10 years and it's final salary. So, and the rules around that would be, what's your best salary in the last 5 years? But obviously we've had 60,000 for the last 10 years, so that's all I've been in. So 60,000 for 10 years. So you take it divide it by the factors. So 60,000 divided by 60 is 1,000. That's why I use that figure. And so £1,000 per year is what you're going to get as a pension. You've been in the pension scheme for 10 years, so 10 times 1,000 means that your pension on retirement is £10,000. It's far more complex than that, but that's a very simple thing. And career average is just as your salary goes along, each year you accrue a bit of pension and you add up all those bits you've accrued each year, and that's the amount you get at the end of the year. Normally you can take up to 25% of that tax-free as a lump sum. Unless the government change the rules around that, and the remainder bit, the 75%, is then paid to you as an annual or monthly, but it's an annual pension to you. But you need to look into the rules. So if you've got a defined benefit scheme, look into the rules, and hopefully they've got retirement modelers so you can put in, I think I'm going to retire at 65. What pension am I likely to get? So that's very useful. So it's not what you pay, not what the employer pays in. It's length of service, pensionable service, and how much your salary has been in those years. In defined contribution, as I say, the more you pay in, the more your employer pays in, the bigger your pot, the bigger you've got. As like £250,000, you might go to an insurance company and say, I've got £250,000 in my pensions pot. How much would you give me as an annuity? And you can buy yourself an annual pension. And maybe they'll turn around and say, £10,000 a year will give you, whatever it might be. So there's that aspect. Or you've got 250,000, you take 25% tax-free, and that leaves you a pot of whatever that is, 200,000, and you can then draw money down as and when you need it, and you just pay tax to your marginal rate. So, but of course, the more you draw down, the less you've got for the future, and depends how long you live. Collected defined contribution schemes, as the term says, DC, so it's got DC in there, so it is defined contribution. And the world of pensions think that it will be probably better than a normal DC scheme, but not as good as a DB scheme. I don't know really, but that's what they're saying. So it sounds like it could be a good move, but it's down to the employer what pension scheme is chosen for employees. And so if the employer thinks CDC is the right way forward, they'll obviously speak to the pension providers. They'll seek legal advice and everything else. And if don't forget, if you change in pension schemes as an employer, then you've got 50 employees, if my memory's right, or more, you need to consult. So there'll be a consultation on change of pension schemes and stuff. But it sounds like it could be a good thing.
I want to ask you, this could be about pensions or just more broadly in life. What's the best piece of advice you've ever been given, Andy?
I remember my dad once saying to me, just left school, said, you need to get yourself a job. Go and get yourself a job in local government. So I applied and I got a job for first one after school. And it was in fact, it's probably the start of my payroll career, the very first job, because it was organisational methods, work study, time and motion. But actually it was also a bonus clerk. I had to calculate the bonuses for the weekly paid staff. and pass it on to payroll. Anyway, within a year, I got made redundant.
Oh, no.
And I got moved to payroll.
Oh.
So although my dad said it was a secure job, it wasn't really a secure job, but it ended up with me working in payroll and then moved from Milton Keynes to the South Coast and did that. I think for me, it was probably getting qualified.
Would you say that's your proudest achievement then?
Well, actually, funny enough, I didn't actually get the qualification. As in, I became a fellow of the Chartered Institute through experience. Mm-hmm. I taught, but never did the thing. I did AAT. That was the qualification bit. But that led me to the point, I think, I don't want to do. Economics was great, but the rest of it, I thought, no, payroll is so good.
So is there anything else you'd like to add today, Andy, about the world of pensions?
It's always changing, just like the world of payroll. And in fact, they're both so interconnected. And because payroll, as we all know, is the end of the line, so everything falls on payroll at the end of the day to get right. And also to feed all the other systems. So pensions relies on payroll getting it right. And if payroll gets it right, pensions have got a very good chance of getting it right as well when they do their bits. Yeah.
Yeah, and they're both very compliance heavy.
Yeah.
Yeah.
Yeah, compliance enforcement, And working for the serious and complex team at the Pensions Regulator, you realise how important it is that employers get it right.
Yeah. So you mentioned there about the regulator. Mm-hmm. How can people prepare for a pensions audit?
If it was me, so you're going to get, so it could just be you get contacted to say, we just want to check a few things. Remember, regulator gets RTI information, so they can look at your RTI submission. The HMRC do sort of work it all through and are doing checks to see whether or not you've got people who should be enrolled. So they might say you've got 100 people, looks like 50 of them are people who are eligible job holders who should be automatically enrolled. There's no employee contributions. Ooh, is that salary sacrifice or is no one in the scheme? So you could just get a phone call or you may get an inspection. And the regulator will inspect all large employers. If you're a large employer, you will get an inspection at some point. They do by sector, so it could be like transport, farming, agriculture, whatever. Different sectors get looked at. Geographical regions, so they might go to Birmingham, to London, and just do checks on what seem like random checks, but actually sometimes it's quite decisive checks because RTI is throwing up information that looks iffy. Or maybe there's a whistleblower. Someone in your organisation has said, I'm not having the right pension contributions deducted. I should have been enrolled and haven't been. And the regulator will look into that and don't need to disclose the name. And if they haven't got permission from an individual, they won't. But they will come and ask and maybe inspect. And if you get a letter of inspection, or you could get a request for information, and you've got no choice. If you get a request for information like, please give us these pay slips for this period of time, etc., then you've got to give it. You don't need to worry about GDPR and all that stuff. The regulator has the power and you have to disclose. And if you don't disclose in the time frame, you're potentially going to end up getting fined. So in terms of preparation, if you get an inspection notice, they'll say in the letter, these are the things we're going to look at. These are the things we want you to have available ready for us. If your payroll is done by a payroll bureau and the records are at the payroll bureau, then the regulator will go to the payroll bureau as well. Or the payroll bureau needs to send the records over to you as an employer. But that needs to be organised. So there's that prep work in the background to be done. And they will look at the individual calculations. They'll look at maternity cases. They'll look at the scheme rules. They'll look at what are you doing postponement. How's re-enrolment gone? Did you declare on time? Because if you don't declare on time, you're going to get an automatic £400 penalty. And also it's a red flag. Oh, what's going on? If they can't declare on time, then maybe they're not doing automatic enrolment properly. So remember, it's 5 months from your duty start date or 5 months from the third anniversary for re-enrolment that you need to get declaration compliance in. So get everything ready. So if you get it all organised, so when they come in, you've got all the paperwork to hand, or it's easily available if it's online, and you know the answers. So what are the postponement rules? When someone goes maternity leave, are you doing the right thing? Check your calculations, be certain. And if you find, oh, actually, I've got an error, tell them. It's okay. They're there to help. They will want you to fix it and fix it in a reasonable time frame, but they're not going to fine you. Only going to fine you if you don't do it. If they say, right, you've got 28 days to provide this information, you don't do it, right, then potentially you're going to get a fixed penalty notice, £400 fine, and say 6 weeks to provide the information. If you don't do it after that, then you're going to get an escalating penalty notice, which depends upon your size. So over 500 employees is £10,000 a day. So one company got fined £350,000 because they didn't do it. And that was 35 days that they took to get to the point of satisfying the regulator that they now were able to provide the information, or whatever was wrong, that is now being put right, or that in the position that they can put it right. So but that's not going to happen unless you don't it's not me. Don't do that. Just be open, honest, and just share, and the regulator will help you fix it if it is wrong.
Thank you for joining me today, Andy.
That's all right. It's been a pleasure. Thank you, Laura, for inviting me.
And Andy's kindly left a question for our next guest, and here it is. What was the most defining moment of 2025? I can't wait to hear what our next guest has to say about that. There's certainly been plenty to choose from. And so you don't miss that, hit subscribe or follow behind the button on your favourite podcast player. And if you're watching us on YouTube, tap the like button, drop us a comment, and make sure you subscribe so you never miss an episode. And we'd love to get questions, suggestions, and payroll stories direct from you. Just email behindthebutton@cipp.org.uk. We'd love to hear from you. Thanks for tuning in, and we'll see you next time.